Like hedge funds and mutual funds, private equity funds pool resources from multiple investors to spread risk and increase buying power. It's what they invest in that sets them apart. Hedge funds and mutual funds may invest in stocks, bonds, money markets, and other financial products, and they can generate profit quickly. In contrast, private equity funds investments are narrower and longer term. They target companies in a promising startup phase or companies in trouble that need restructuring or new management. These investments often take years to pay off. 10-year time horizons are not unusual. They're popular because they can offer strong return streams that have low market correlation with public market investment opportunities. The trade-off is that these investments are much less liquid and require a longer investment period. Generally, private equity funds use one of two methods of investing: venture capital and buyout, or leveraged buyout. Let's look at the most popular kinds of private equity more closely. Venture capital, a minority investment in a high-growth company with minimal revenue at an early stage in the company's life cycle. It's not uncommon for VC deals to return 10x multiple of invested capital to investors. Growth capital, or growth equity. These investment opportunities involve companies that are more developed than classic VC investment companies. This means they're less risky, but have less upside potential. A successful growth equity investment will typically return at least 3x multiple of invested capital to investors. Mezzanine financing. This may be offered in the form of subordinated debt, junior to senior debt, or preferred equity, where return expectations are around 15% to 20% per year. Mezzanine financing in general compensates investors in the form of interest combined with upside participation, i.e. equity or options warrants on equity. Leveraged buyout, or LBO. LBOs are the bread and butter investment strategy for most private equity firms. In an LBO transaction, a PE firm, called a financial sponsor, or a group of firms, called a consortium or investor group, acquire the target company using debt instruments for the majority of the purchase price. Debt typically represents about 60 to 75% of the total price. Distressed buyout. In a typical distressed buyout, a private equity firm purchases a financially distressed company below market value with the intention of divesting the company in the future for a higher value. The two main causes of distress for a company include excessive financial leverage and operational volatility, such as a cyclical business.